Hey guys, Lincoln here from BoAcademy.org. Today I want to talk to you about inflation. There's so much that we have to cover on this channel, but in order to get to all of that and fully understand how to leverage our money and other people's money to build our wealth over time, we first have to understand what inflation is, how it affects our money, and how it affects our larger economy. Because inflation is a very fundamental and necessary concept in any economy, right? And when it's done right, it can be beneficial to the economy. And when it's done poorly, when it's done incorrectly, it can be detrimental. So in this video, let's cover what inflation is and then briefly go over some examples of when it's good and when it's bad. So inflation is a very simple but very powerful concept, right? All inflation is the increase of the price of goods and services in an economy over time. Right, and as that happens, as inflation occurs, that means your money becomes worth less, right? The value of your money decreases because the cost of goods and services in the economy cost more. So your money can buy you less and less over time. Remember when you were a kid and you used to get $1 from your parents and go to the corner store down the street and you would bring back 4 items. 4 of the best treats that your local corner store had, right? Because each of them cost 25 cents. But fast forward a couple years and you're in middle school or high school and you go to that same corner store and they're charging you $1 for each of those treats. So now your dollar can only buy you one of those treats you used to get for 25 cents. So now you get $1 from your mom and it's worth even less to you, right? That's inflation. As a kid, you didn't understand why that was happening. You just thought the corner store was becoming greedy, right? All of a sudden you go to the store and they're charging you 4 times more for the same item, and you're just a kid and you have no idea what's going on. So now you have to go to your mom and say, hey mom, I need $4 to get the same thing I used to get 3 years ago, right? So that's inflation. That is how it affects your money. The cost of goods and services go up over time, and your money effectively becomes worth less, becomes less and less valuable. The purchasing power of your money decreases, right? So every single year, inflation occurs if the economy is functioning correctly, right? Notice I said correctly, not incorrectly, because inflation, when done correctly, when done properly, is actually a good thing for our economy because inflation allows our economy to continue growing. We're going to cover this in more detail later. But one of the reasons that inflation occurs is because the Federal Reserve, the government, introduces more money, more currency into circulation in the economy, right? So as more money enters the economy, right, it's a supply and demand. As more money enters the economy, the value of the existing dollars, right, the value of the existing money in the economy becomes worth less because there's a greater supply now of money than there was before, but demand has not increased enough to offset the increase in supply. So as more money is introduced into the economy, each dollar becomes worth less. So because inflation causes your money to become worth less, your money is worth more to you today than it will be in the future, right? So if you're an investor, you want to keep that in mind, right? If you have more money today, if your money is more valuable today, then it can give you better returns on your investment today than it will be able to in the future. Right? That's why it's good to have your money in your own hands so that you can invest it today, right? And if you invest it correctly, you can actually offset the cost of inflation. So if you invest in good assets that yield returns above the rate of inflation, then you effectively beat inflation, right? Your wealth does not go down with inflation because your assets are returning you more money than the cost of inflation. So your money might go down by 2% to inflation, but your stocks might return you 8-10%, right? And your real estate might return you 20-50%. So effectively, you're beating inflation. You're offsetting inflation. That's why it's important to invest your money today as soon as possible, because the longer you wait, the less valuable your money becomes, and so the less it can return to you over time, right? So the Federal Reserve targets a 2% inflation rate every year. So why would they want this? Because it helps the economy continue to grow. As they introduce more money into the economy, the more money there is to go around, and so then businesses are getting more money in their pockets, and they're able to pay their employees more money, and then their employees are able to spend more money, and that means that there's more money going into somebody else's business, which means that they can pay their employees more, and then the circle goes around and around and around, and our economy continues to grow over time because there is more and more money in the economy, and there's more money to go around for everybody. So if the Fed targets a 2% inflation rate, if they want to cut the value of your money by 2% every year, you have to do whatever it takes to make sure you can offset that cost, that decrease in the value of your money. This is exactly why I don't like savings account, because savings account are a ripoff. They only give you anywhere from 0.01% to 2% return on your money, interest on your money, right? So the value of your money decreases every year by 2%, and then your savings account is saying, hey, here's 0.01%, here's 2%. You're either going to be losing money to inflation or just matching it. So the value of your money just stays the same in the best case scenario. But for most people, they're getting pennies in return for their money. And the banks are taking all that money and making profit, investing in stocks and real estate and other financial markets to take all the profits, right? They're getting 8%, 10%, 20% every year, and they're giving you 0.01%. It's a scam. It's all a scam. Of course, savings accounts are good for keeping your money temporarily if you need to save money for your emergency fund, which you should have for 3 to 6 months, right? But anything beyond that, you're just burning money. So we'll cover that more in another video, but this is the basis for why I don't keep much of my money in a savings account, because it's just burning, it's losing its value. Why would I do that? I want to invest my money in assets that will beat inflation every single year. That's stocks, that's real estate, right? Bonds, we'll cover that more. So another positive to inflation is that because your money becomes worth less every single year to inflation, debts become cheaper over time. So if you take out a loan for $10,000 and the inflation rate is 2%, the value of your money is going down by 2% every year, but your loan is still $10,000. Right? So if your money is worth 2% less, but your loan still costs the same, you're effectively paying 2% less every year for that loan. So as you pay it every single year, you're actually paying less, because that $10,000 that you have to pay over time out of your own pocket is actually worth less every year. So this year, $10,000 is $10,000. But next year, that $10,000 becomes $9,800. Right? So as the years go on, the cost of your loan goes down by 2%, right? So every year you're paying 2% less to cover your loan, right? That's a great thing. That's why I'm in no rush to pay off my student loans. That's why when my parents told me they want to pay off their mortgage early, I said, no, don't do that, because your mortgage is going to be worth less every single year. And your money is worth more to you today, so you should take that money, instead of giving it to the bank so that they can do whatever they want to do with it, take that money and invest it today so that you can beat inflation. So as the cost of your loans go down, your money actually increases, your wealth increases. So you have more money to pay off that loan that actually costs less over time. So your mortgage won't cost as much tomorrow, in the next year, in the next 5 years, 10 years. So there's no reason to pay it off early, unless of course you want to cut your debts. But a mortgage is a good debt, right? There are good debts and there are bad debts. So inflation can be a great thing, but if the Fed allows inflation to increase by too much every year, then it can get very bad. And the value of the dollar can go down so much that a loaf of bread costs you $1,000. We've seen this happen in other countries who have allowed inflation to increase way too much. But if we keep inflation around 2% every year, then inflation is a good thing for our economy. So when people talk about inflation and they're all hysterical and they're trying to fearmonger, that's all it is, they're fearmongering. Inflation is not an absolutely bad thing. It's mostly good when used correctly, right? So when you see people out there talking about, oh, the Fed's putting too much money, they're making our money worth less, don't listen to them, because they don't understand what inflation is, what the value of it is, and how to leverage the fact that inflation is going to happen every year to build their wealth. So all they're left with is being fearful, right? Don't be fearful because other people are just fearful. Understand these concepts so that you can use them to your advantage. So the opposite of inflation is deflation. And I'm telling you right now, deflation is a terrible thing. You do not want deflation to occur where you are at any time. Deflation can destroy economies. We saw this in the Great Depression. Little known secret, deflation was a leading cause for the Great Depression, right? Because in deflation, when deflation occurs, the value of your money increases over time. So what does that mean to you, right? That means that if you just wait another day, then you're going to be able to buy more things for less money, right? So people naturally say, oh, I can just wait till tomorrow to buy that new car, to buy that new house, to buy that new TV. And so people don't spend their money, and they keep waiting every day so that the value of their money can continue to increase. So if people don't spend money, what happens in the economy? The economy grinds to a halt, because if you're not spending money, somebody else isn't making money. And if they're not making money, they can't afford to pay their employees. And if they can't afford to pay their employees, they have to let them go. And if they let them go, then people don't have money coming in to pay for the goods and services that they need. And if they cannot pay for goods and services, then somebody else, another business, is not making the money it needs to continue to operate. And then they have to fire their employees. And it goes in a terrible, vicious cycle, right? And this is what happened in the Great Depression. People kept holding on to their money because they knew that tomorrow their money would be worth more and more and more the longer they hold it. So they weren't spending money, businesses weren't making money, right? And then investments went down too, because no one wanted to start a new business. Remember that with inflation, the cost of your loans decrease over time because the value of your money decreases. So you're paying less over time. But with deflation, the value of your money is increasing over time. So you're paying more to service your loans over time. So if loans become more expensive over time, then no one wants to take out loans. So they don't have enough money to invest in new businesses. And if they can't start new businesses, then they can't hire more employees. And if they can't hire more employees, then there's not enough money circulating through the economy. And if there's not money circulating, then the economy just continues to go down in this vicious cycle, right? So deflation is terrible. Inflation can be good if we're done right. That's what we have to know about inflation and the opposite of inflation. Inflation is good when done right. So thank you for watching this video. I hope you now understand what inflation is, what the value of it is, how it affects your money and the larger economy as a whole. And I hope you're starting to get a sense of how to leverage the fact of inflation to build your wealth over time. We're going to cover more and more as we go on in this journey. But now that we understand inflation, we can do so much more with this knowledge. So that's all for now. But remember to always practice the bull mentality, right? The bull mentality is that we know what we invest in. We understand what we invest in. We believe in what we invest in. And we hold for the long term. That is how we build wealth in this country, right? And as the value of our money goes down every year, we can still offset that inflation by investing in great assets and holding for the long term. So if you enjoyed this video and you learned something new, please remember to like this video below, subscribe to the channel, and hit that notification bell so you always know when we publish a new video. And comment below what you've learned and what you would like to learn in the future. I enjoy responding to every comment, so I look forward to hearing from you guys below. I'm Lincoln from bullacademy.org. Thank you again and have a great day.